To help start setting the context on the finance side, I'm going to ask Zaheer to come up and give us his thinking on international climate finance and progress we are making. Thanks, Zaheer.
So if I stand, then I'm the stand-up comic or sitting fool? Which one do you
Comic sounds good.
Comic? Okay. Good morning, everybody. My name is Zaheer Fakir. I work at the Department of Environmental Affairs. I am pretty much responsible for the Green Climate Fund because I was together with Minister Manuel. We designed the Green Climate Fund. But I'm also the focal point for many of the other funds. And unfortunately, I'm also the chief finance negotiator for the developing countries in the negotiations. So when things go wrong, I'm the one to blame. But maybe one doesn't understand clearly what the finance architecture is all about. The climate finance architecture deals with two areas. There's an internal and an external area. And by that I mean internal within the UN framework, and then you have an external one which is outside the UN framework. The Green Climate Fund finds itself within the UN framework. So it's guided by principles of the UN, but it's also guided by the conventions. And there's something called the operating entities of the financial mechanism of the convention. You'll hear us negotiators talking a lot of that. The whole story starts in Rio. Steve, is it fine if I can just give you a context of it? So in Rio, you had these major conventions coming where the world recognized we needed to deal with some of these problems. One of it was climate change. The other one was biodiversity, and there was a few others. So these conventions were given birth in that time. But at that point in time, developing countries were saying, well, in order for us to meet these commitments, we do require financing. So if you look at the UN Convention on Climate Change, there's an article in there called Article 4, which deals with the commitment. That articulated what the commitment would be, where developed countries would provide financing. But it's important to look at the fine language. You guys are all bankers. You always have these fine prints at the bottom. You know, we don't look at the fine print, but the fine print is very important. At the time of Rio, it was provisioning of finance, and it was about providing incremental cost financing. In simple layman terms, is that the international community would only provide you with financing to cover global benefits, not your national commitments. So out of Rio came out a fund called the Global Environment Facility. I sit on that fund's council. I'm a focal point for that. I also do the replenishment of that fund. That fund provides financing, but only for the incremental cost component or global benefit. And what that means is that if you are going to do a mitigation project and you were going to provide electricity, a simple example was if you were to connect a community to a coal power station, let's say it cost you $10 million, but you could have done it through a renewable way and it maybe cost you $15 million. So the GCF would step in and say, we'll give you the 5 million, you were going to spend the 10 anyway, and that way we derive global benefit of emission reductions. So important to note that is if you're ever accessing financing or seeking to access financing from the Global Environment Facility, you require co-financing. You got to put money down to get money. It's the same principle if you go to a casino. You got to put money to win money. Hopefully. Unfortunate thing is that in the GEFs and that, the co-financing ratios are not in your favor. So for every $1 you want from them, they expect you to provide $5 or $7 in co-financing. So just bear that in mind. The Green Climate Fund, on the other hand, operates a little differently. It doesn't have a per se co-financing requirement, but it has this notion of leveraging. And the reason for the leveraging issue stems from what happened in Copenhagen. In Copenhagen, the commitment changed. So if you read the Copenhagen, the 100 billion, and if you read the 100 billion commitment, it says developed countries will jointly mobilize 100 billion from all sources. In that. So the word of provisioning changed to mobilization. And today, the Paris Agreement is all about mobilization. Meaning, I will provide you the $1, and the $1 must go and leverage $10, $15, and together we'll count that towards the 100 billion. So people are under the false notion that developed countries are going to give you 100 billion for it. It's not It's not the case. So if you're dealing with the Green Climate Fund, they're going to demand that you provide some level of leveraging. That's why when you look at the Green Climate Fund's dashboard, they say our portfolio is 5.6 billion and co-financing of 15 billion, so a total portfolio of 20 billion. And what developed countries then announce to the world is that we have mobilized 20 billion towards, however much of it is coming from you. The other challenge is that much of that money actually doesn't exist. So what happens is when you present a proposal, you are anticipating that this is the money you're going to, it's not actual money that's there. You might get this money, you might get private sector to put money in, etc. So just to contextualize, today if you are dealing with any financing mechanisms, co-financing is an important thing, leveraging is an important thing, and also remember, today most of the instruments are loans. Loans, guarantees, credit lines, results-based payments, grants have gone. Grants are very small. So the latest joint report of the multilateral development banks claimed that they had provided 43 billion for climate finance. And of that, they've co-financed 68 billion. That 43 billion, 70% of that is loans. Grant components are only between 5 or 6% of that amount of money. And more money is there for mitigation, less for adaptation. So if you look at the 43 billion, 30 billion is mitigation money, and only 12 billion adaptation. And you ask the question, why? If you look at financing for adaptation, very little money. The adaptation fund that Mandy was talking about, that fund has only a total amount of 800 million, of which it has a portfolio of 600 million. It runs on a budget of roughly 100 million, but what is important is to understand where the revenue for those funds come. It doesn't come from a capitalization by donors, like the GCF or the GEF. It takes a levy from the CERs, or what they call certified emission reductions. Those come out of the CDM process. I imagine everybody's familiar with the CDM. So whenever you do with this clean development mechanism projects, they generate a CER, and then we slap on a 2% levy on that, and 2% goes to the adaptation fund. The challenge you have is that that levy, 2%, is dependent on what the carbon market price is for those CERs. When the adaptation fund started, the carbon market price was $20. And when I was on the board, the market price was 20 cents. And adaptation funding today, the largest amounts for the adaptation fund comes from such a mechanism. So I see Steve looking at his watch. Maybe I'm digressing. But let's focus on that important thing. You will hear a lot of stories of people saying these acronyms, billions to trillions, and there's trillions of money out there. It's like the poem, The Ancient Mariner. I don't know if any of you did it in school. But there's a part in the poem where it says, water, water, everywhere, no drop to drink. There's a lot of money out there, but nobody seems to be able to access that money. And the question is, why aren't you able to access the money? When you're dealing with these funds today, mobilization becomes a problem. Any project that you want, if you can't show or demonstrate mobilization, leveraging potential, is a project that people on the board look dimly on. Because if I'm a donor, I want to make sure that I get more money for that $1 I spent, so that I can go in the global community and say, we are achieving these targets. Transformation. They want to see projects that's transformative. By that, they mean game-changing projects, right? Not run-of-the-mill projects. So if you come with another ordinary renewable energy project, the question is, why should we fund this? We're already funding. There's enough money out there. Why should you do it? If you're coming with adaptation, the challenge is the global benefit issue and the additionality. They start questioning, well, what is the global benefit of dealing with a seawall? How does it benefit me in Germany? Why should a German taxpayer's money be spent on you dealing with something? It's a national commitment. So the whole question of this climate rationale becomes something that they look for. The second thing that is a problem in adaptation is that there's the perception that there's no opportunity for private sector, or very limited opportunity for private sector, right? And private sector is what every donor wants to see in their portfolios, right? So in the GCF, you have a private sector facility. You'll hear through the replenishment processes, they want to scale up. But the perception is that private sector cannot make money out of adaptation projects. I'm not saying that, but that's the perception. I do a renewable energy project. There's revenue generation. They're going to be able to pay the money back. I can make some profit, etc. I do an adaptation project. The chances of getting... So we need to be able to demonstrate the opportunities for private sector in the adaptation space. So there's a lot of opportunity, but you finance people say there's no deal flow. I don't see the projects coming there. My job, apart from telling Mandy what to do, is I'm the focal point for the GCF. I'm the national designated authority for the GCF, for the Green Climate Fund, the Global Environment Facility, Adaptation Fund. Projects that get submitted to these funds need me to provide a no objection letter or an endorsement letter. And if I'm getting something, we start looking for various things. The one thing we look for is the things of, is it aligned with government's priorities? You don't have to be a government department or whatever. It can be a private sector project. But does the project align with what government is trying to achieve? Does it meet the global requirements? The GCF has certain requirements that they want to see, or the GEF, so that. Does it meet that? Is the co-financing in place? Do I have a relative comfort that you will provide the co-financing? And depending on the kind of nature of the investment, if it's a partnership with government, do you require sovereign guarantees or whatever else in there? Those are the kind of things that we would look at before we provide. And then on the other side, I also sit on the boards, and I've chaired the Green Climate Fund board. When we're looking at the board, we look at scalability. What's the potential to scale this? Is this a one-off project? We now prefer programs rather than projects. We don't want to deal with $105 million projects, but rather a $500 million program. We look at de-risking potentials. Can we, through this project, reduce the risk so that it creates an enabling environment for future investment without the injection of multilateral financing? We look at the commercial viabilities of these things, because much of it is loans. Somebody has to repay the loan. If a project is not going to be able to generate revenues in it, how are you going to service those loans? Yes, you'll get concessionality. They'll give you good concessionality. Sometimes not so great, because the concessionality that the funds are giving you gets blended with the bank's concessionalities. But you will find that they don't look at projects that does not have the potential to be able to. Nobody wants to finance something like that. And then you have the other challenge of who you are. If you're South Africa today, the world views you as a middle-income country. Irrespective of what vulnerabilities you are, how many poor you have, they view you as a middle-income country, and that impacts the way in which these funds react. If you look at the Paris Agreement, they view vulnerable people purely as least developed countries or small island states. And why is it important is that when you come to the funds, and the GCF does provide you grants, when you come to a fund and seeking a grant, and irrespective if the project is for a rural woman community or whatever, they see the label South Africa, middle income, you cannot get a grant. You have to take a loan. So this is part of our challenge as negotiators to deal with that. Or if you come with a large project and you're looking for concessional finance, they're going to say, middle-income country, you cannot get the high concessionality. You should get. So these are some of the challenges. What we do find from my side is the lack of transformative projects. I see a lack of programs. I see a lack of things that are scalable. And also I see lack of innovation. Sometimes you may have projects that are important, but they're of a small nature. But nowhere in the fund are they going to approve these $1 million projects. So think a little bit out of the box. Maybe in the agricultural sector, instead of coming with a project, speak to a financial institution, look at getting an injection of capital into the financial institution, which can do the on-lending to those small farmers, rather than coming with a project with a small farmer. So you got to start thinking a little differently when you're dealing with projects. Maybe I should stop there, Steve, because I hope I've confused people completely.
No, it was good. So a couple of follow-on questions from me. You've spoken about these challenges. Is South Africa getting projects? Are they surmountable?
Just give you the figures. Mandy in the Adaptation Fund has $10 million. Of that, it's split up between a project in the Umgeni area and a small grants program. Global Environment Facility has been in existence for 25 years. We have, over the period of time, accessed around 195 million from the Global Environment Facility. That's over a period of 25 years. And co-financing there is in the range of probably 1.2 billion. On the Green Climate Fund, we have a portfolio of around $700 million. Co-financing or leverage amount 2.3 billion. Obviously, in the Green Climate Fund, it's also multi-country projects. So South Africa is also part of if you look at purely South Africa, it's roughly $200 million. From the Climate Investment Funds, $450 million we've got from that fund. But the Climate Investment Funds does not deal with adaptation funding. It's purely mitigation funding. And then you have some other smaller funds like the Special Climate Change Fund. But you need to understand that not all funds finance adaptation. So the Global Environment Facility does not finance adaptation, only mitigation. It has a smaller fund that funds adaptation, which it administers. The Adaptation Fund, because it has limited money, you're only given a max of $10 million to get. So South Africa cannot technically get more money out of the Adaptation Fund. But if we can generate more funds for the Adaptation Fund, that then obviously lifts the ceiling on that. The Green Climate Fund, current replenishment is around 9.6 billion for the next 4 years. It does both mitigation and adaptation. But obviously, then preferably they're looking at providing larger size projects with larger amounts of funding. Climate investment funds, I'm also on the board of that. That has about 8 billion. We can generate another $3 billion in the climate investment funds, but countries like France, Canada, and the others are actually blocking that from happening because in their view, we have the Green Climate Fund, so these other funds are. And then you have bilateral donors that provide funding. So Germany has a program called ICI, International Climate Initiative. It provides, usually it has an annual allocation of about 60 million euros globally, and you can access money from there. And many of our other bilateral donors do have funds, but most of them are now decreasing their funding to South Africa on the basis of this middle income issue. You will hear it often coming in their statements saying we want to support the poorest of the poor. They don't see South Africa in that way. And then you have a lot of the bilateral development finance institutions, KFWs, Agence France Développement, the French development agencies, the African Development Bank, World Bank, the IFC. So there's a multitude of sources. But at the end of the day, if you're not having those key elements, the transformativeness, the scalability, the leveraging potential, the private sector components, those are the kind of deciding factors that would determine how sexy your project is for them. Because those are their priorities, right? Their priorities is to show that we want expanding the private sector. So projects that have greater private sector are going to be looked more favorably. Projects that have greater leveraging potential will be looked more favorably. Projects that are transformative in nature will be looked because they are game-changing things. Scalability is also things that, so it's ability of doing something that's going to be able to leverage more action. It's going to be unlocking more money in the financial sectors. It's creating the evidence for bankability, or it's making it mainstream like you look at renewables. 20 years ago, renewables was a novel thing. Today, every bank has got a renewable portfolio and that you don't really need that amount of money in them.
Wait, 2 questions from the audience, one at the back here.
Good morning, Zaheer. I'm Michael Sudakis from Africa Business Group and new member of the PFAN network. My question was if you, from a baseline standpoint, could disaggregate the information that you just gave us and talk a little bit about private sector receipt of funding from these funds? Because as you mentioned at the beginning, they're serving both the public sector and the private sector, but our interest is, as has been mentioned, is in the private sector. So if you could talk about if any of these lean more toward the private sector, that would be helpful. And to date, again, if you could disaggregate for South Africa, what funds private sector projects have received.
Take that question.
Yeah.
Good morning. Thanks for the update, Zaheer. This is Shilan Rajkumar from SASL. In relation to a previous update that you provided to the NBI a few years ago, and considering now your current feedback, I think it's seeming more and more onerous in terms of accessing this fund. So linked to the previous question, and it's one of the questions that I raised previously as well, there was a lack of appetite for the public and private sector to come forward to actually present, I think, project scopings around what could be accessible from a funding perspective. And whilst noting that there is capacity that needs to go into the development of concepts and pre-feasibility studies, etc., to the level that is required to ascertain whether a project is at a status where you could potentially take it forward or close shop in terms of investigating further. What do you see now as being the trend in the South African context from a public and private sector with regards to the application or coming forward to you and approaching yourself for these funds? Because I think from a private sector and from a SASL perspective, you know, it seems doom and gloom from where you've pitched that. So I think considering the capacity and the resources that need to go into it, I think we'll need to take the discussion forward as to where the opportunity does lie, if any at all. Thanks.
Okay. All right. The focus of this discussion was very much adaptation, right? But I think we're delving into the mitigation side of things. But to answer your question, the large programs that we have with the GCF is actually private sector oriented. So what it is not actually financing an individual private sector project, but creating a credit facility within the DBSA to finance private sector. So there is one that is dealing with embedded generation. In the layman's term, the context there was that many private sector operators had bidded for the renewable energy program, were not successful for this program. But their projects are still valuable projects that could. Now, in the terms of the program, the benefit was getting the guarantee from government, etc. So what DBSA has done is that how can we still support those private sectors? So they've gone to the GCF and gotten $150 million from that, which they will blend with their own money to provide financing for those private sector operators who were not successful but do have valuable projects in it. So that is the kind of thing that you're looking at. You can either look at an individual project from the private sector, but then looking at a program, or looking at different financing facilities in it. So this is the discussion we've been having with Nedbank or the other financial sectors, and that is getting that injection of money into there. So it buys down that risk, brings down the hurdle rates, etc., so that they can on-lend it to the private sector in that. The challenge you have when you're dealing with these funds is, and it's not limited to private sector or public sector, there's no preference for one over the other. But when you're dealing with these funds, there's a lot of conditions, which then dissuades a lot of private sector, because not that you are anti-environmental social safeguards and all that, but when you deal with these funds, there's a plethora of reports that they want before you even get it to the board. What is your gender policy, and what is this? And if your gender policy doesn't align to their policy, so you have all these things. Right? I'm not saying their policies are right or wrong. Please don't look at me that way. But they have all these kind of conditions in there. So when you start engaging with a private sector person, right, the average on many of the funds was 2 years before you even seen an approval. Now you tell me, if you're in the private sector, can you wait 2 years before you even see approval? So part of the challenge we face is how do you make these funds operate on a basis that it is conducive to the private sector? And so what you're finding, what's happening on a lot of the GCF projects is that you don't get private sector coming to the GCF. You're getting multilateral banks coming, or bilateral banks. So the European Investment Bank will come and they seek like $500 million and they would blend it with their money, and then at some point in time they would then invest in their normal investment projects. So we have a project from the European Investment Bank that was approved in 2016. Till now, not a single cent has been disbursed. But this is the trend that we're finding, right? We're finding that you're not getting private sector institutions, but you're getting the financial institutions who are coming, seeking money from the funds, using it either to blend with their own money or to backstop their capitalizations or whatever else, but you're not actually getting the private sector operators themselves or the industry themselves coming to the funds. And we want to work with the private sector industry, both and the financial sector. The problem we have in South Africa is that there's so much opportunity, but there seems to be some kind of lethargy. I don't know where it comes from. And the opportunities are then being snapped up by the Indians, by the Latin Americans. You go and look at, they have a whole range of portfolios with the private sector there, which we don't have. Something closer to Sasol, I had a discussion last week with the Chemicals Industry Federation Association. They're looking at doing projects, and the trend now is to look at blended finance. Blended finance in the sense that using the high concessionalities of GCF to unlock other finance out of some other financial institutions, so there are these opportunities. It's just that it's difficult for us to engage. We are so far from yourselves, right? And the other problem I have is also an issue of good governance. Because I'm the focal point, because I'm the NDA, because I'm the one who has to provide the no objection letter, there's a fine line between me engaging with you and then being an arbitrary person on the other side having to endorse something. So we have that bit of a challenge in that. But there is a lot of opportunity for the private sector. The challenge we find is that we're not finding these innovative ideas coming up. We're not seeing, I don't know, I may be under a false assumption, but I get a sense with South African private sector, they tend to be very fixed on this idea of we've been always doing things this way, why should we change? Not very forward-looking. And the change often comes when you are forced to change. I'm just purely basing it on something. It may not be the fact. But I don't see our private sector sitting down and saying, okay, where do we see ourselves as Sasol in 20 years' time? How do we be a global competitive player in there? What do we need to do now? You may be doing that, but I don't see it, right? So all I see is the interaction with the industry today who's saying, well, we can't meet these emission standards or something like that. And the narrative between the industry and the department has always been, well, the department has been a roadblock for economic growth or something. So this is something that the minister is changing. She wants the environment department to be a catalyst and a motivator for. So that's why we're going out right now, but more proactively to the industries to see how we can. Because we have a lot of leverage in many of these funds. Not because we are South Africa, but because we are bastards in many of these funds and give them a hard time. So often you can use those kind of, I'm sorry, Steve, I used the language and you're videoing it. I hope you bleep it out. But we have leverage in many of these funds. So you can twist a little bit of arms in it. But you need to see the stuff, I need the ammunition for me to go there. I can't go and say to them, well, there's a lot of opportunity for private sector, and then, okay, so what do you have? And I have nothing in my pocket. And it's the same challenge that Mandy would have at SANBI. There's a lot of opportunity in the adaptation side, but if you're not seeing those projects come there, it's very difficult for SANBI to take things to the GCF, and it's very difficult for SANBI to make these compelling arguments to the GCF why they should be putting funds there. Remember, money is very limited. Even though people say trillions, if you look at the last initial replenishment of the GCF, in 2012, around there, their replenishment was $10 billion. Now they only have $9 billion. Right? So in these multilateral funds, they are declining. So it's become more and more a requirement to be able to actually take that little money and leverage the other money. You're not going to get the full cost funding out of these funds. So you need to be also engaging with your potential financiers and your other players in that. What we're looking at with the chemicals industry is more of a program. So it's a number of chemical companies within a certain area who's looking at doing a program around there which has energy benefits. It has benefits around improving their technological processes, has benefits around water because they use a lot of water in that. So those are the kind of things also that adds favorably to projects, the co-benefits of these projects. So I'm not just doing a project with mitigation potential, but a project that is also having social benefits, creating job opportunities, economic growth, and those type of things.
Thanks. Thanks very much for that, because it fits so well into the narrative we're trying to put in your heads here. The first step was, wow, we need to adapt. There are some physical climate change risks coming here that are enormous. But then our next response is, oh, well, we must be given all this money and we must do this thing. But actually, getting access to this money is not that simple. And you did a great job of explaining that the money is there. Maybe the window is closing a little bit over time, but that we need to be much more innovative and courageous about how we innovate our projects. So that's great. Thank you.
Just two last points, just from a negotiation perspective. You'll hear one of the things in Madrid that was not solved was the issue of markets, or Article 6 as that. Forget the acronyms, but one of the key reasons on that is that there's a big push from developed countries for the markets issue because they see their potential of doing mitigation work purely through the markets, not through actual physical projects or recapitalization. The challenge that we want to see out of that is that, as I mentioned earlier, the revenue for the adaptation fund comes out of the CDM process. What we want is that there needs to be revenue coming out of the markets in order to go towards adaptation. The problem in Madrid was that there was resistance from the developed countries to have the proceeds from those markets flowing into the adaptation fund. So that's the one thing that you should, when you will hear media talking about the markets and those type of things, the big challenge is that there is today major talk of ambition in mitigation, but no ambition in finance or adaptation. The second thing you need to look about is this whole talk about alignment with the Paris Agreement. In the Paris Agreement, there are three aims in the Paris Agreement. The one is the temperature one, the 1.5 degree. The second one deals with adaptation, scaling up adaptation. The third one is making all financial flows consistent with low emission and climate resilience. The first one is prioritized. So the way you prioritize that, they see that as enhancing the ambition of the nationally determined contributions. And you will hear a lot of talk by the Secretary General and expecting countries to enhance their NDCs. The other two are the ones, the adaptation one, there is a resistance from the developed world to actually set a goal for adaptation, a global goal for adaptation. And the third one is the dangerous one for you in finance. Because what it talks about is not about scaling up finance, but it's shifting the flows of finance. So taking money, which we are using maybe in fossil fuel investments, and shifting it to low emission, which sounds great. The problem is, take a company like Sasol. If Sasol is going to come and seek financing from a multilateral development bank or a bilateral agency and that, their shareholders are forcing them to align with the Paris Agreement and align with that Article 21C. What they will say is they are not able to provide financing to Sasol because you have fossil fuel on your balance sheet. And it's a similar thing for Eskom, and it's a similar thing for our financial sector, because many of them have investments that are not green. And so this is the big thing that we've been fighting against. So everybody glibly says, yeah, we need to align with the... One doesn't understand the unintended consequence of that. For a country like South Africa, let's say, even though the projects that you are coming up with are low emission projects, the mere fact that you have something on your balance sheet and that would prevent them from providing finance to you. A simple thing, I think, was the Roger Federer case, if you've seen that, where he took, he's got funding from Credit Suisse. I think it's Credit Suisse. One of the banks are sponsoring him. And there was a large outcry from civil society and everybody because Credit Suisse has fossil fuel things on there. So be very vigilant when it comes to these kind of things. And don't think of us negotiators being too hardline. The reasons why we be this hardline is around how do we secure financing for you guys? How do we secure an enabling environment for you to be able to grow economically and have the development space to grow in that? I'll stop there.
Brilliant, thank you. Yeah, thanks. I want to kind of sum that together. You've got a supply and demand side issue here. Supply side is typically the financial products that you need, and clearly we need some innovation there. And the demand side is the project side. Now, when I talk to the finance community, the thing they talk about most is no projects, no pipeline. We've got funding, there's no pipeline. And so we as a community have to start thinking much more carefully about how we deliver projects. And they are saying that about mitigation. If you start thinking about adaptation, they've never heard of adaptation pipeline, right? And so what we're trying to do here with this process is to start getting us to think a little bit differently about how we build the different kinds of finance we used on the supply side and start thinking a bit differently about the quality of the projects and the pipeline that we need. And the biggest issue there, which I will come back to, is cash flow or cash. It's producing something that you can sell. Right? So this is our quick chart on how we think about finance. If you think about the amount of capital you might need over time and risk, right? So the longer the time that goes by, the lower your risk becomes. Does that make sense? The shape of the curve looks something like this. So early on, you're starting something, you don't need as much capital, right? But it's quite high risk. You haven't proved it. No one knows if it can work. They don't know who you are. You don't have a record, right? And then over time, you need different kinds of capital. So if we divide these into kind of 3 phases, this early phase, which is high risk, right? The kinds of capital that you draw on are venture capital, grants, sweat equity. So you've got to watch out the finance community. They have all of these phrases that actually mean basic English things. So sweat equity, as you can imagine, is the effort you put in, your own kind of capital. And then angel investing. So really wealthy investors, Bill Gates gives you $100 million to go and do something fun, right? Does that make sense? As your project matures, you start to get different kinds of finance. So concessional debt. So debt at a rate lower than what you would get from your bank, and guarantees and private equity. So someone offers you a share in your project and they give you some capital, right? Make sense? And then once you get up to this level, you have standard commercial debt. You're a business, you borrow from a bank, you pay it back over time. Does that make sense? Now, South Africa has some structural issues. So we don't really have any wealthy investors. You know, all our wealthy people go overseas and start electric vehicle companies. Zaheer was talking about grants are also on the decline. It's not that easy to get grants anymore, right? Fortunately, what we're talking about here is there is some grants available in the adaptation space. We also don't have a lot of venture capital. Right? I was reading the World Economic Forum's Global Risk Report, and one of the areas where we perform worst is in venture capital. And we also don't have a lot of private equity. Right? And so if you're trying to do a project, you're pushing it through on your own effort, what little grant you can get. If you can survive long enough, you might be able to get some concessional debt. Concessional debt's a bit better, so the development bank's a bit more aware, and then eventually you can get to commercial debt. But a bank, an investment bank anyway, isn't really interested in you if your project is smaller than 500 million. So there's a scalability challenge. To get from here to 500 million when you can only get relatively small grants. I mean, I think the biggest grant that the Green Fund of the DBSA gave out was like 62 million, right? So you've got to scale that up more than 10 times. No, slightly less than 10 times. Don't film that bit. To get to kind of investment bank level, right? Does that make sense? And so what we've got to be able to start doing is saying, so even though GCF money sounds like quite hard to get, and even though it might take a long time to get it, so we've been working on a Green Climate Fund proposal in the mitigation space for like 2 years now. It's just how long it takes. I expected it to take 3 months, but unfortunately that's just how long it takes. And so there's opportunity to work with people like the NBI to help you get through that long period. Obviously, you can't be doing this full time for 2 years. There's no corporate that would allow you to do that, but we can, right? And so how can we work together to solve some of those timing problems, but also where can we use our collective power, both in the finance sector, but also in sort of the other corporates. So for example, can we use some of our CSI money to provide venture capital, right? We spend quite a lot of money as a set of corporates on CSI. Can we put some of that aside to start thinking about venture capital, private equity? Does that make sense? Also, maybe, so does that make sense? I want to pause there, see if there are any questions. Right? So we've got to be better at combining all of these things. So using GCF money here, using some GCF money here, using some other money as well. So DFI money in particular, using some CSI money here. Corporate debt's not a problem we have to solve. South African banks have quite a lot of money, but they can't spend it at this kind of risk level. They're even regulated against it. I'm pretty skeptical about sustainable finance and impact investing and so on because they're always asking for return, right? And so therefore they're normal finance, right? The issue there is you might sometimes get concessional finance, right? So for example, we are building a project with one of the commercial banks around energy efficiency, and they are prepared to give us a reduced price on their capital because the outcomes benefit society, right? So there are instances that you can do that kind of work with commercial banks, but you have to make a pretty solid case for why, and there's a long-term market change opportunity that they believe will become a very viable market in the future. So for them, it's like a strategic investment. So those options do exist, but the idea that there's a sustainable finance that's a separate bucket from finance, I don't really buy, but it might impact some concessionality. It might also impact how much risk a financial institution is prepared to take, right? The concept we need to know about there is net present value, right? So if you're thinking about a project, you invest a certain amount of money up front, right? It's going to cost you X amount of capital, and then over time, you generate some returns, and hopefully they're getting bigger and bigger, right? And because of the time value of money, you would work out the present value of all of these cash flows and subtract them from the cash flow you put in up front, and you might have small cash flows as you go along, and you get to a number. And if that number is positive, then you have an exciting project. Right? And there's all sorts of risk mitigation and financial innovation things you can do to make that more attractive. The fundamental problem is what you're trying to do here is fund a project that doesn't have any of these. It's got negative cash flows, right? So you take that to a bank and you say, you know, and Zaheer brought this up as well, is how do I pay back this principal amount, right? And so, okay, well, if we use a grant, that's okay because I don't have to pay back the grant, but grants are declining, right? Plus, we can't really scale with grants. We need other forms of finance. So then we have to get a little bit more innovative. And so some of the examples I use at municipal level is, you know that road in Cape Town that runs along the beach? Like it's a long road. Quite often it gets sanded over, right? Now, the guys whose job it is to maintain the dunes are saying, hey, if we maintain the dunes, it's going to cost us X amount, right? But then you don't have to grade it every 2 weeks. You don't even have to own a grader. You don't have to spend money on the diesel, right? So somewhere, someone is saving money, It's not actual money though, because it's a deferred cost. It's a saving, so that's even harder to get to grips with. But it should be logical that at a budget level, you allocate the money to maintain the dunes, not by the grader. Does that make sense? Right, so that kind of deferred cost finance is a part of it. But now you've got two different government departments. You've got the guys whose job it is to maintain roads, who's fighting for budget, and you've got the guys whose job it is to maintain dunes, who are fighting for budget, and it's hard to get them to agree. It's the same example in the business, right? You've got the operations guys who want to raise the dam. You've got operations guys who say, well, the nature guys who say, well, if we maintain the upstream catchment, you won't have the kind of offlows, right? So partly it's getting to grips with that deferred cost. And the other part where we as a community have to innovate is on the project side. Can we design a project that creates cash flows? Right? So to take a Tiger Brands example, if Tiger Brands are trying to do an adaptation project with communities in Limpopo and Mpumalanga, right, they can guarantee offtake. They can say, if you grow tomatoes at this quality, we'll buy them. So you know you're going to get this amount of money at this price, right? And that provides the banker or the finance institution to say, okay, there's a cash flow there that I can start to think about. Does it make sense? So your question is right. We haven't solved that problem, but there are glimpses of how we will solve that problem. And that's what a lot of the next two events will be about. Let's find examples where we've managed to create financial flows. The other option is insurance, right? So insurance companies are quite good at saying, hey, I'm going to pay out X amount in insurance premiums because of natural disasters, but if you manage your infrastructure differently, these go away. I would be prepared to put some of that in here. Not all of it, because I want to make some margin, but I'd be able to. So now we've got this opportunity for blending. So we spoke about blending on the finance side. Now we've got blending on the cash flow side. So I'm going to get some support from insurance companies. I'm going to get some demand certainty from off-taker. I'm going to combine that with some innovative finance. That is really our only way that we're going to get to the size of projects we need to mitigate the risk we talked about last time with Bob and Francois. Does that make sense? We haven't started talking about small enterprises yet because there's a whole, we're just thinking about this from an environmental perspective, but there's a whole social component we can add to this. We are all committed as companies to improve small businesses, access to markets, and so there's a whole bunch of CSI style, EDD style funding that can go into this kind of project design. Does that make sense? Do you want a quick question or?
The comment that I wanted to make was that I found that with the projects that we'd actually identified, right, the mileage hasn't been that great. Why? Because we funded them, right? So everything that we're planning to do this year in that space, when I talk to the ESD guys, we're not seeing anything big. And I'll use a simple example. I've always complained within the organization to say, you look at the amount of factories that we have in the East Rand area. Why don't we do something big in terms of soil rehabilitation in the Brakpan area, right? If I go into that space in terms of doing a great project within an agricultural context because of the nature of our business, then I've actually achieved two things. But because then I have to fund it, Noel can only give me so much, right? So last year I was like, yeah, 50 million. Then I woke up, we struggled, and he's like, no, I can only give you so much, right? And I think that's why I asked that question earlier on, because I see big opportunity in terms of us doing something big, and then I get away from this whole thing of having to import all these raw materials and commodities that I can grow locally and actually make a difference. That's why I asked that question very much. So
how we go forward is taking an idea like that as a community, saying, okay, what financial innovation can we do? What project side innovation can we do? Who can you work with? Can we pull in
to do a composting project
somewhere else?
Exactly.
My question is, can that work for the funds? For the GCF and the Green Fund, can that work to unlock those kind of finances?
What do you mean?
The modeling, what you just explained there, can we put as some kind of a motivation?
So we have actually
something like that.
Yeah. So Zaheer and I had this chat 4 years ago, in Cape Town. So the challenge, and Zaheer would know better than this, right? Better than me, the challenge for the GCF is they're fundamentally public money, right? And so they are beholden to the governments that provide them that money, and therefore aren't as risk tolerant as we would like them to be. So I don't think it's likely anytime soon that a green climate fund is going to play here very much. Whereas this kind of thing, guarantee, mezzanine debt, concessional debt, those kinds of financial products are more realistic, I think, for a green climate fund. So we have to find other solutions for this band, right? Or find projects that are mature enough and risk tolerant enough that we go straight into this band. Do you want to say anything on that?
There is grant money there because the GCF does have a grant facility, but it's project preparation and grants, right? And many of the bilateral donors, like say, if you're looking at getting probably some concessional finance out of KfW, the German government would make project preparation grants also available. So there is ways of circumventing that. It's not impossible to do it. What they're also looking at is that what we need to be considering is that what the GCF and that is also looking at, even though they can be very difficult, they want to use their investments to do evidence-based. So often, they may be not the risk appetite, but by doing something, you create a evidence base for the potential of these things to happen. So then you cover the replicability side of things, right? If it works in South Africa, it could be replicated and done elsewhere in the world or something like that. So it's just about not having a defeatist approach and saying, well, okay, we're never going to get that. Yeah. It's just looking at what tools there are there in the toolbox and how better to use the tools that you have.
Yeah, maybe to describe the NBI journey on the GCF project we have going is we got a 4 million Rand project preparation facility grant in order to prepare a proposal that requires the GCF to give us a guarantee of about $10 million. Doesn't sound right, sounds too little. And we will get $70 million from a private sector bank, right, to the leverage part. And we will get a grant, we hope, from the GCF to reignite the PSEE, those of you who remember the private sector energy efficiency program. So it is possible to do these things. It takes time. I mean, I don't know if we'll win it, but it's possible to at least put proposals in. So it is possible. It's just we have to think differently.